This podcast is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research before making any investment decisions. All right, guys, let's talk about something that's probably going to bore you to death, but it's the exact strategy that's creating actual crypto millionaires while everyone else is getting wrecked chasing the next Dogecoin wannabe. Dollar cost averaging into Bitcoin, holding through crashes. That's it. That's the whole strategy. And I know what you're thinking. Where's the excitement? Where's the 100x altcoin? Well, here's the thing. 90% of day traders lose money. 90%. Meanwhile, the boring guy who just buys $100 of Bitcoin every week for 5 years is sitting pretty. Let me walk you through the real numbers here because this is where it gets interesting. If you had started dollar cost averaging just $100 a week into Bitcoin back in 2020, not trying to time the bottom, not waiting for the perfect entry, just mechanically buying every week, you would have stacked almost one full Bitcoin by the end of 2023. One Bitcoin. And yeah, you would have gone through the 2022 bear market where Bitcoin dropped from 69,000 down to 15,000. That was brutal. But here's the magic of dollar cost averaging. When Bitcoin was at 15,000, your $100 bought way more sats than when it was at 60,000. You were buying the dip without even thinking about it. Now, fast forward to early 2026, where we are right now, Bitcoin's sitting around $85,000. That same person who just kept buying through the bear market, through all the fear, through the news saying Bitcoin was dead, they're up massive. And they didn't have to predict anything. They didn't have to know when the bottom was. They just showed up every week and bought. Here's what I want you to understand about dollar cost averaging. It removes emotion from the equation. You're not sitting there at 2 a.m. refreshing coin market cap trying to catch the perfect entry. You're not panic selling when Bitcoin drops 20% in a day. You set up automatic buys, weekly or monthly, whatever works for your budget, and you let math do the heavy lifting. When prices are high, you accumulate less. When prices crash, you're loading up. Over time, you're averaging down your cost basis, and that's incredibly powerful in a volatile asset like Bitcoin. Let me tell you why this works better than what most people do. Most people see Bitcoin pump to a new all-time high. They get FOMO. They throw in a big lump sum then it crashes and they're down 40% and they panic sell. They bought high and sold low, which is literally the opposite of what you're supposed to do. Dollar cost averaging forces you to buy at all price points, the highs, the lows, the middle, and statistically, you're going to catch way more lows than if you're trying to time it perfectly. Now, let's talk allocation because this is super important. I've been looking at what actual crypto millionaires do, not the ones who got lucky on some meme coin, but the people who built serious wealth over multiple cycles. And the common thread is they keep 50 to 70% of their crypto allocation in Bitcoin, not some random altcoin, not the new Ethereum killer of the week, Bitcoin. The rest might be in Ethereum, maybe a small position in one or two other projects they really believe in, but the core is Bitcoin. And this is where most people mess up. They think diversification in crypto means owning 30 different altcoins. But here's the reality. Most altcoins don't survive a full market cycle. They pump, they dump, they die. Bitcoin has survived every crash since 2009. Ethereum has proven itself as the number two. Beyond that, you're taking on exponentially more risk for what? The chance at 100x? The odds are stacked against you. I'd rather take the boring 50 to 70% Bitcoin allocation and actually sleep at night. Let me give you some context from what's happening right now in the market. Bitcoin just went through 4 consecutive red monthly closes, first time since 2018. It dropped 38% from the all-time high of $126,000 back in October 2025. Right now, we're sitting around 85,000. 46% of Bitcoin holders are underwater on their positions. People are scared. But this is exactly when dollar cost averaging shines. While everyone else is panicking, the DCA person is just buying their weekly amount like clockwork, stacking more Bitcoin at a discount. And here's the thing about support levels. Bitcoin is sitting right around where most of the institutional money came in through the Bitcoin ETFs. The average cost basis for those ETFs is around $84,000. That's real money, billions of dollars worth of buying pressure sitting right here. The realized price, that's the price everyone paid for their Bitcoin, that's around 56,000. The 200-week moving average is around 58,000. Those strong support zones, we do get another leg down. Those are the levels where I'm getting even more aggressive with my buys. Now, let me connect this to dividend investing because I know a lot of you guys follow this channel for the dividend content. And yeah, I hold both dividend stocks and Bitcoin in my portfolio. Here's how I think about it. My core portfolio, the stuff I'm never touching, that's SCHD, VOO, VTI, those are generating passive income through dividends, growing over time, tax efficient in the right accounts. That's the foundation. That's 70 to 80% of my investable assets. Then I have a satellite position in Bitcoin, about 3 to 5% of my total portfolio. And the reason I do this is because Bitcoin and dividend stocks are not correlated. When the stock market crashes, Bitcoin doesn't necessarily follow. When Bitcoin crashes, my dividend stocks keep paying me. It's diversification across asset classes, not just within stocks. And over the last 5 years, Bitcoin has absolutely crushed stock market in terms of total return. Yeah, it's way more volatile, but if you can stomach the volatility and you keep your position size reasonable, it can juice your total portfolio returns significantly. Here's the other thing. Bitcoin is becoming more institutional. We've got spot Bitcoin ETFs now. We've got companies like MicroStrategy buying billions of dollars worth. We've got countries buying Bitcoin as a reserve asset. This isn't the Wild West anymore. It's still volatile, don't get me wrong, but the infrastructure is there. The regulatory clarity is improving. And if you believe, like I do, that governments are going to keep printing money and debasing fiat currency, then Bitcoin's fixed supply of 21 million coins starts to look really attractive as a long-term store of value. Now, let me talk about the actual mechanics of setting this up, because if you're going to DCA, you need to make it automatic. I use a few different platforms depending. For Bitcoin, you can set up recurring buys on Coinbase, Kraken, Swan Bitcoin, whatever exchange you trust. You link your bank account, you set it to buy a fixed dollar amount every week or every month, and you forget about it. The key is making it so easy that you don't have to think about it. If you have to manually log in and execute the trade every time, you're going to skip weeks when you're busy or when the price looks scary. Automation removes that. And pro tip, don't keep your Bitcoin on the exchange long term. Once you've accumulated a meaningful amount, move it to a hardware wallet. Ledger, Trezor, whatever. Not keys, not your coins. We've seen exchanges go bankrupt. We've seen exchanges get hacked. If you're serious about building wealth in crypto, you need to take custody of your assets. Yeah, it's a little bit of a hassle to set up, but it's worth it for the peace of mind. Now let's talk about the HODL part of this strategy, because buying is only half the equation. You also have to hold through the crashes, and that's where most people fail. They DCA for 6 months, they're up 30%, they feel like geniuses, then Bitcoin drops 50% and they panic sell at the bottom. Don't do that. The whole point of dollar cost averaging is that you're in this for the long haul. You're thinking in terms of years, not months. You're accumulating through multiple market cycles. I want you to think about this like dividend investing. When you buy SCHD, you're not checking the price every day hoping to flip it for a quick profit. You're buying it for the dividends, for the long-term growth. For the comp Bitcoin is the same mindset. You're stacking sats. That's what people call small amounts of Bitcoin. You're holding through volatility, and you're betting that over 5, 10, 15 years, Bitcoin's fixed supply and increasing adoption are going to push the price way higher than it is today. Let me give you some projections here because I think it's helpful to see where this could go. Base case for the end of 2026. Analysts are looking at Bitcoin somewhere between $120,000 $170,000. That's 40 to 95% upside from current levels around 85,000. Bullish case, 200,000 to 250,000 if we get a real liquidity surge post-halving. Bearish case, we drop down to support around 56, 70,000, which honestly would just be a better DCA opportunity. And here's the crazy part about stacking a full Bitcoin. Right now, if you're DCAing $250 a week, it's going to take you about 10 years to accumulate one full Bitcoin. By the time we get to the next halving cycle, it might take 15 years. Bitcoin is getting more expensive, and the window to own a full coin is closing for most people, unless you seriously ramp up your weekly buys. That's not to create FOMO, but it's just the reality of the math. The earlier you start, the easier it is. Now, let me address the elephant in the room: risk. Bitcoin can go to zero. I'm not going to sit here and tell you it's guaranteed to go up. It's a relatively young asset. It's still figuring out its regulatory environment. It's volatile as hell. That's why I keep my allocation small, 3 to 5%. If Bitcoin goes to zero, it's not going to destroy my retirement plan. But if Bitcoin goes to 500,000 or $1 million over the next decade, that 3 to 5% position could become 15 or 20% of my portfolio just from appreciation. That's the asymmetric bet. And this is why I compare it to how I use high yield covered call ETFs like Connie or MSTY. Those are satellite positions. They're not my core. They're tactical bets that I'm willing to take some risk on because the side could be significant, but I'm not betting the farm. Bitcoin is the same. It's a satellite position. It's speculative, but it's speculative with a strong fundamental thesis around scarcity, adoption, and the debasement of fiat currency. Let me also say this: if you're going to DCA into crypto, Bitcoin should be your primary focus. Ethereum is fine as a secondary position if you believe in smart contracts and DeFi, but beyond that, I would be really careful with altcoins. The data shows that most altcoins don't survive a full bear market. They get hyped in the bull run, they crash harder than Bitcoin in the bear, and they never recover. There are exceptions, but picking the exceptions is incredibly hard. It's easier to just stick with Bitcoin, let it do its thing, and not get distracted by the latest narrative. Now, I want to talk about tracking all this, because if you're doing dividend investing and crypto investing, you need a way to see everything in one place. I built retireearlywithdividends.com specifically for this. You can track your dividend stocks, your ETFs, your crypto positions, all in one portfolio. You can see your total dividend income, your cost basis, your unrealized gains, all of it. And it's free. I built it because I was tired of using 10 different spreadsheets and apps to manage my investments. So if you're serious about building wealth across multiple asset classes, check it out. It'll save you a ton of time and headache. Here's the bottom line, and I really want to drive this home. Patient capital wins. Time in the market beats timing the market. Whether you're buying VOO, SCHD, or Bitcoin, the strategy is the same. Show up consistently, buy through the ups and downs, hold for the long term, and let compounding do its thing. The people who make life-changing wealth in crypto aren't the ones chasing moonshots. They're the ones who bought Bitcoin at $300, held through the crash to 3,000, held through the crash to 15,000, and kept stacking. That's boring. That's not sexy, but that's what works. And if you're sitting there thinking this sounds too simple or too slow, I get it. Everyone wants to get rich quick. But here's the truth. Most people who try to get rich quick end up poor. The boring strategies, dollar keeping your position size reasonable, those are the strategies that actually build wealth over 5, 10, 20 years. And if you start today with $100 a month into Bitcoin, in 2031, you're going to look back and thank yourself for sticking with it. So here's what I want you to do. If you're convinced, set up a recurring buy today. Coinbase, Kraken, Swan, whatever platform you want. Start with an amount you can afford to lose. 50 bucks a month, 100 bucks a month, whatever fits your budget. Set it to automatic. Then forget about it. Don't check the price every day. Don't panic when it drops. Just let it run. And if you want to track it alongside your dividend portfolio, head over to retireearlywithdividends.com and plug in your positions. You'll see everything in one place. That's it for this episode, guys. No hype, no promises, just the boring strategy that's creating actual millionaires while everyone else is losing money on leverage and altcoins. If you enjoyed this, hit subscribe. We'll see you in the next one.